Hi, everybody. I'm Courtney Hoffman. I am the Director of Planning here at Everpar Advisors. And today I am joined by Michael Christian. He's one of our lead advisors. And today we are going to be talking about Roths, predominantly backdoor Roths and mega backdoor Roths. So welcome. Glad you're here with us today, Michael.
Well, thank you for having me.
Absolutely. Let's start off on the backdoor Roth, because this is one that I feel like we hear about a lot and there's always a lot of confusion around it. So would you mind kind of diving into what exactly that is and some of the details around Roth versus traditional IRAs?
Yeah, that's a great segue, Courtney, and thank you. I think the first thing we want to do is just contrast a traditional IRA with a Roth IRA. So in a traditional IRA, very similar to your 401k plan that you may have at work, you're taking pre-tax money, you're putting them into a tax-deferred retirement vehicle, and that money is growing on a tax-deferred basis. Let's say you have it invested in the market. And then when you reach retirement age, which is 59 and a half, you can then pull those monies out. In a traditional IRA, you are then paying tax on those monies that have enjoyed all that tax-deferred growth. And when you pull those monies out, they are treated as current income. Now, we contrast that with a Roth IRA, where you take after-tax money, so money that you've earned and paid tax on, you put it into a Roth IRA. Similar to a traditional, it is growing on a tax-deferred basis, but because you've already paid tax at retirement, so 59 and a half or later, you can then pull those monies out and you do not have to pay any tax on the growth. So essentially you're having a tax-free growth vehicle. The difference between a traditional and a Roth IRA. The thing about a Roth IRA is that it does have an income limitation. So if you are an individual filing taxes, that limitation for your income is $153,000. If you are married filing jointly, then that limitation is $242,000. So there is this income limitation. So for us in this example, let's say that we have a couple each earning $150,000. They're earning $300,000 combined when they file their taxes. They make too much money to invest in a Roth or to contribute to a Roth. And so that is where the backdoor strategy comes into play. And in essence, what we are doing, or the mechanics of it, is that we have a traditional IRA account that is opened, and we have a Roth IRA account that is opened. And what this couple will do is they will make an after-tax contribution to the traditional IRA, and then immediately do a conversion from that traditional IRA into their Roth IRA. And this is what is known as the backdoor Roth IRA strategy. And that simply allows you, a high income earner, to take money and put it into a Roth strategy that can then grow tax-free until retirement. And the limitation for that is $7,500. If you are over 50, there is a catch-up provision, so you can contribute up to $8,600 in this strategy. Now, $7,500 or $8,600 may not sound like a lot in any one year, but if you just ran a simple scenario where if you and your spouse or significant other each contributed the maximum amount, and let's say that you're 40 years old, and until retirement, and we'll say retirement's 65 years of age, if you just contributed the maximum amount, so each you and your spouse were putting in $7,500 while you're in your 40s, $15,000 a year, and then bumping up to the $8,600 catch-up provision, each of you do that over that 25-year time span. So if you're contributing from age 40 to age 65, the contributions plus the growth, assuming that you'd put it into, let's just say, a stock market portfolio that was earning 8% per year, that would be $1,080,000 that you have accumulated in that portfolio that you can pull out tax-free in retirement. So just the benefits of investing long-term into a Roth strategy or a backdoor Roth strategy and the compounding of the returns that you get make it a substantial savings vehicle for retirement.
Following the backdoor mindset now, it always sounds kind of elusive when you say backdoor Roth, but actually when you explain it, it's very clear. So I would say here at Everpar that we really see kind of three primary drivers that cause confusion around these, and you hit on one of them extensively, which is that income limit. The other thing is just the timing of how to do it. Is there a time of the year to do it, or, can you do it for the prior year? And so just having really clear communication on that is always really important. But I'd say the third thing that really catches people up is the pro-rata rule. Could you go into a little bit more detail of how that pro-rata rule works?
Yeah, so I mentioned earlier that to deploy the backdoor strategy, you have to have both a traditional IRA and a Roth IRA. You put the money in the traditional and then you convert it to the Roth. Now, if you have money, existing money in a traditional IRA, you can't just roll over the monies that you immediately put in there because they do have this pro-rata rule. And to give you an example, if I have, let's call it $92,500 in my traditional IRA this year, and I put in the $7,500, and then I want to do a conversion of that $7,500 into the Roth IRA, the IRS is not going to just look at that $7,500 conversion and say, okay, you don't pay any tax on that, you did this conversion and all is great. They're actually going to look at the pro rata breakdown, and on the numbers I gave you, they add up to 100,000. And if you do the percentages of what we contributed versus the original balance, the 92.5 versus the 75, it's about a 90-10 split. So if I were to then do a rollover into the backdoor Roth, I would then have to pay tax essentially on that 90% that I rolled over, but the 10% would be tax-free. And so one of the things that we guide or counsel clients on is to say, well, if you already have a traditional IRA balance, it may not make sense to employ that backdoor strategy.
So a lot of us have 401k plans or we have employer plans. Is there a way to do a similar strategy through our employer plan versus just by using the IRA and the Roth IRA vehicles?
There's a similar conversion strategy, and you may have heard about this. It's called the mega backdoor Roth strategy, and it's called mega because you can ultimately put in a substantial amount of money. So when we think about a traditional 401k plan, you have both your contribution, you have what your employer may match, and then there's also an IRS limitation. And so for 2026, the limitation or the amount that I can put in if I'm under 50, just to keep the math simple, is $24,500. There's also typically an employer match. And so let's say I'm earning $200,000 a year and my employer matches 5%. And so that's going to be another $10,000. So if you add the $10,000 that my employer is contributing to my 401k plus the $24,500 that I put in, together that's $34,500. Now, the IRS limitation for a contribution that I put in, the employee, and for the employer is actually $72,000. So there's a gap there of $37,500. Now, what some plans do allow is, one, they allow you to make an additional after-tax contribution to the 401k plan. So you're going to have to read the documents to understand that. But one, if you can do that, and then also if the plan allows for you to do either a conversion within the 401k plan itself or do an in-service withdrawal, meaning that I put the additional monies in there and then I'm allowed to take them out and put them directly into a Roth account that I've set up with a third party, I can do this mega backdoor strategy where essentially I can put in more money that is the difference between what I put in and my employer put in and that $72,000. So reverting back to that scenario that I just laid out for you, that gap of $37,500, I could technically do a mega backdoor Roth where I did an after-tax contribution back into the 401k plan of that $37,500, and then I either converted it within the plan to the Roth or I did an in-service withdrawal and put it into a third-party Roth. Either way, I was able to contribute a substantial amount and put that into a Roth, and again, benefit from that tax-free growth vehicle.
I'm just thinking back to your prior example of just doing the IRA amount of $7,500 and how that could grow. Think about if you were putting, like you said, 30-something thousand into the mega backdoor Roth and letting that grow over the years. That's going to have a really significant impact at the end of the day.
Yeah, it can be an amazing savings tool for retirement, again, if your plan allows. Now, the one thing that I would say is there's not a lot of plans that do allow this. The standard employer plan won't, but we have seen a handful of either, smaller company plans or those in the tech industry that do allow it. And again, if you want to know whether you can do a mega backdoor Roth, you can reach out to your plan's administrator, or if you are able to get a hold of the plan documents, they will tell you whether you're allowed to do those things or not.
And then I guess if you're a business owner and you have control over the plan, you could actually incorporate that into your plan if you don't already have it.
Yeah, that's a great point. You can work with your administrator and rewrite those documents or put those provisions in to allow for that mega backdoor Roth contribution.
So when you see these different strategies really come up in planning conversations, like what signals you to alert the client of these strategies?
Yeah. So typically when we're doing planning, it comes up in kind of three different scenarios. And the first one of those is, are you already maxing out, your 401k or other saving strategy? And you say, well, what other vehicles are available to me to take advantage of either, pre-tax or after-tax growth? And obviously this is one way to do that. That tends to be where it comes up in conversation. The second thing is if you already have a small IRA and it just makes sense to go ahead and do that initial conversion. Earlier, we talked about that pro-rata rule. And if you have a small balance in there, maybe you're willing just to do a one-year conversion where you are paying the tax, but now you have nothing in that traditional IRA and you can begin employing the backdoor strategy with no additional kind of tax liability into the future. And then the last kind of opportunity that we see from a planning standpoint really has to do with that gap year of when you retire versus when you need to take your RMDs. And if you think back to a 401k or an IRA or traditional IRA, you are going to be required to take out an RMD at age 73. But let's say that you take monies out at let's say that you retire at age 65. You have an 8-year window there where maybe you're no longer working and you no longer have earned income. And because you no longer have earned income, that could be another opportune time to look at doing kind of Roth rollover or Roth conversions.
From an estate planning lens or any other reason that might trigger us to want to look at either Roth conversions or the backdoor strategies?
Yeah, it's a great financial planning tool having monies in a Roth, because when you think about a traditional IRA, let's say I'm at the point where I'm starting to take RMDs, I pass away, and that money then goes to not my spouse, but let's say my heirs. There is then a 10-year rule where, based on kind of their life expectancy, they are starting to have to take RMDs every single year for a 10-year period. And they will be paying tax on that, the heirs who inherited your IRA. The Roth has the added benefit of being, inherited by your heirs, but they don't have to technically take that money out for up to 10 years. So it still is subject to the same 10-year rule period, but they're not going to be required to take an annual distribution. And so they can let those monies grow for 10 years tax-free and then take a distribution or take all that money out tax-free at the end of the 10 years. So it's a pretty powerful estate planning tool, having money in a Roth as well.
Yeah, sounds like it. All right. Well, I appreciate you coming on today. It sounds like, this is a really great opportunity, potentially, whether you're utilizing it through a plan or whether you're utilizing it just as a side strategy for both younger and all the way up to RMD age because of that conversion opportunity. So thanks for joining us today and appreciate it.
Well, thank you for having me, Courtney. And I encourage anybody that's thinking about contributing to a Roth or the Mega Backdoor Roth to reach out to us. There is some nuance we didn't get into today, but you want to make sure that you understand all the IRS rules and regulations so that you don't run afoul of them. So if there is an interest, we are happy to have those conversations with you. Thanks, Courtney.